Hello everyone, Joshua Hayes at bigwavetrading.com. Thank you very much for watching this video. Want to say happy Father's Day to all the dads out there and also a happy Juneteenth to everyone. That being said, we're going to be looking at the SPY in this video lesson, but I want to let everybody know it's going to be kind of messy looking. These are all the lines we're going to be showing, but I want you to know this is really all I ever pay attention to: price and volume. This indicator, this indicator, this indicator, this indicator, and all of the lines you see are just information, data that I use to trade. So with that being said, the SPY following last week's sell-off is extremely oversold. What you're looking at here is a 3 ATR band of the 21 EMA, something that I always use to let myself know in the short term, are we overbought or oversold? Now, how I like to use this is whenever you get reversal candles off the highs, you can start to go short with the stop, a protective stop above this level. When you get to the lower bands, when you get a reversal candle, you can get long above the candle high with the stop below here. You could also sell put credit spreads. There's multiple ways to use this. I don't personally use it like that. I use it as information. And as you can see, it doesn't always work. You have a buy stop here. I don't know if it triggers on these candles, but if it does, you get stopped out when it closes below there. You get another hammer candle reversal off it, you take profits, then you got to get stopped out. Hammer candle reversal, take profits, you get stopped out. Started to get one here, never triggered because it's got to trade above the high of the day price. So we're at that lower 3 ATR band, and unfortunately, Telecharts does not take into account the dividends, but SPY was actually up on Friday. But short term, just wanted to show everybody we are oversold. We should expect a bounce. This is a daily, but if we look at a 4-hour chart, we can see the same thing. But if we look at a 195-minute chart, we can also see the same thing. I keep saying but because I'm waiting for this TTM trend momentum to turn. I actually thought it came earlier. My apologies. But on the 130-minute chart, you can see a slingshot starting in the TTM trend momentum. You want to even go down further, you can see it on a 2-hourly. So it hasn't developed yet on the daily, hourly, or the 195, but watch for that slingshot reversal for a potential oversold bounce in SPY. We're expecting an oversold bounce. I assume the question, and it's kind of the wrong question here, but the question everybody's asking, did we bottom? Is this the bottom right here? Do we have it? Well, I'll be honest with you guys. I don't think so, but I do believe that we are near bottom. Now, I say this based on evidence, facts in hand. One thing that I have been needing to call a capitulatory bottom for any kind of without a Fed pivot. So I always follow the Fed. Hard rule number one at bigwavetrading.com is always cut your losses. Hard rule number two is always follow the Fed. The Fed is aggressive. They're still tightening. They're going to tighten at the next meeting. Until the Fed actually comes out and says that they are no longer tightening, they're halting all further rate hikes and or they start cutting, or they stop selling and reducing the assets on their balance sheet and start buying again, I have to assume the path of least resistance is down until I get some sign of panic from the retail side. And on that note, when you look at the VIX, we don't have it. At minimum, I need to see the VIX above 40 to start calling panic. The last time that happened was the COVID lows. We have not seen panic in the market via the volatility index since then. Another metric that I use, and it's been pretty reliable, for me, it has been the equity only put call ratio. On that end, it closed Friday at 0.72. I need to see this over 1 multiple days. I also track the 5-day simple moving average of the equity only put call ratio and the 250 simple moving average of the equity put call ratio. The 250 still has not normalized. The 5-day is getting there. I like to normally see this above 0.8, so it is getting there. We don't have the equity only put call ratio on this chart. And it got up to 0.89. The 5-day simple moving, the 5-day simple moving average got to 0.79, 0.79 at its highs. And it did trade above 0.80 intraday, but I need it to close and sustain itself for multiple days over 0.8 to call a capitulatory bottom. So technically, based on the VIX, equity-only put-call ratio, we do not have a capitulatory bottom. Based on the Fed and their pivoting on interest rates, which normally coincides with market bottoms, every major market bottom that we've seen has coincided with the Fed becoming very dovish every time. There hasn't been one where the Fed doesn't get extremely dovish. 2018, the sell-off, late 2018, they were aggressive, and then all of a sudden did a 180. 2020, unlimited QE. This time around, I believe we're going to have to see that. Another thing I wouldn't expect, that bounce off the 2020 lows, see how that's a V shape? This is, and see in 2018, the V shape without a retest of the lows. That happens in quantitative easing environments, not quantitative tightening environments. We're in a QT environment. So even if we do have a bottom here, even if we do, we should expect it to be retested as long as QT is in effect. That being said, since the recent highs to where we stand right now, we're down about 25%. Historically, that's about as bad as it gets for the market during cyclical bear markets. Since 1950, there have been 13 bear markets. 10 have been cyclical, 3 have been secular. During those 10 cyclical bear markets, the average price decline is 28%. In the 3 secular ones, it was 53%. Now, I'm going to show you this weekly chart just so you guys know. Whenever we look, let's show. Do you see these red boxes? These are from here to here, from here to here. This is all part of a secular bear market. This is when I short. When we get below the 200, fail below the 200, and until we have a Fed pivot. Fail the 200, get below the 200 on a weekly SPX until the Fed pivots. This is when I short. As you can see right now, we're still above the 200 weekly SMA. That, by definition, makes this a cyclical bear market still. So if that's the case, we are near a bottom. I don't know if we're at a bottom here, but based on the evidence and the data, we are near a bottom. So, from 1930 to 1950, from 1970 to 1980, from 2000 to 2009, these were basically secular bear periods. So, I do not believe we're in that. I believe that we're in a secular bull market based on demographics, which is the only thing that I can find on a macro level that lines up with the secular bulls and secular bears. And that suggests that this secular bull does not end till 2035. So if that's the case, we're near the lows. Does it mean that we bottomed here? Like I said, no. But here's what I've been doing. When we got down to SPY 400, I started to add back to my long-term portfolios. Mid-2021, I sold off 50% of my long-term portfolios. In perfect hindsight, once the Fed started to hike rates in 2022 in January, I should have gone from 50% of my long-term portfolios to 100%. This is basically the confirmation that following the Fed works, and moving forward, I will more than likely be doing that. When I believe the market is overstretched and I see signs of inflation, I see the rotation that we started to see in early 2021 to 2022. I'll reduce down after a long period of low interest rates. I'll reduce it to 50%, but as soon as the Fed starts hiking rates, I'm going to start going to 100%. But for right now, because timing the market is so difficult, only went 50%. So started to add 10 to 20% in the long-term portfolios at SPY 400. When we hit SPY 380, I posted all the stocks I was buying too in the chat room. It's available for all Big Wave Trading members under the long-term portfolios page. I started to add a little bit more. 20 to 25% of the stocks and the leveraged ETFs that I wanted. Then last week, I started to tier into tier 2 names. Moving forward, I wanted to get long some recession resilient stocks, some stocks that are going to do well even if a recession happens and inflation stays high. Think your consumer staples. I also wanted to finally start getting long more speculative, big cap, mega cap, high quality growth stocks. So I started to do that. but nothing is of size of yet. Where do I plan on actually going for size? So what you're looking at in this chart is just a ton of different lines. I want to let everybody know the thick lines are anchored VWAPs from key price resistance levels or key price support levels on the SPY. And they go all the way back to the 2020 COVID lows. But to get one below current price, I went back to the 2018 lows. What I want to show on this chart is very interesting. The anchored VWAP from the 2018 lows happens to line up with the 50% Fibonacci retracement level from the 2020 COVID lows to the 2021 market highs. That also happens to line up with a key support level. Back in late 2020, SPY ran straight up, finally pulled back, found resistance at the same price level around 350, pulled back, then broke above it, tested it as support. Once was former resistance, should now act as support. It's been straight up since. So we have a confluence of the anchored VWAP, this previous resistance and support level, and the 50% Fibonacci retracement level, which also happens to line up with the 200 weekly simple moving average. So if SPY gets to 350, I will once again, on a closing basis, really start to increase size into the long-term portfolios. However, I won't be going all in. If this is in fact not a cyclical bear market, I am prepared for it to possibly be one of the 3 secular bear markets. If that's the case, the average decline is not 28%, it's 53%, and that means SPY has all the way room for 250, so I'm giving myself room in the long-term portfolios down to 250. My bigger chunk will be added at 350, which I believe should be about the bottom of this market pullback. We'll see. I'm keeping an open mind. If anything, it'll have to be retested. But if 350 doesn't hold, my next round in my long-term portfolios, and all members will know what they are, is at the 62 Fibonacci retracement level at 320. If it gets below that, my next level is 280, and then being in line with a possible 50% to 55% move on the downside, I will, on the downside, go all in all of my long-term retirement accounts or long-term accounts at SPY 250, if that happens. And guys, I guarantee you in 5 to 20 years, we're going to be higher. If we just look at the cyclical bear markets from the bottom, wherever that's at, remember the average is a 28% decline. 6 months later, they're up 20. I'm looking at the stats. It's on my in the public room on my Discord channel. I'll post a link on Twitter and all my social media because I think you have to always update the link. But anyway, 6 months later, you're up 24, 18, 47, 23, 42, 22, 45, 9, 28, 24%. 1 year later, you're up 45, 30, 78, 36, 57, 33, 44, 31, 29, 38. 5 years later, you're up 32, 91, 79, 218, 37, 11, 41, 97%. 10 years later, you're up 61, 341, 110, 312, 41, 6, 144, 364%. I'm looking at my Excel spreadsheet. Was there a single red number stated there on the 6, 1, 5, 10-year time frame? My long-term portfolios are anywhere from 5 to 20 years. So if you're out there and you're thinking about selling, it's a tad too late. Warned about the negative divergences all throughout 2021, posted tons of YouTube videos. All of my members at Big Wave Trading knew about this upcoming potential downturn in the market. You're never certain. Nothing can be predicted 100% of the time. But hard rule number 2 is we don't fight the Fed. So the bottom line is, if you're looking to sell, panic sell here, you're probably in the wrong area unless you think that we're in a secular bear. And I just don't happen to think that. Now, getting back to why I think that on the short term, we could be near a bottom. During this entire downtrend, I'm now going to erase everything from here. Okay, so first off, I'm going to say, even if we are at a bottom, first off, I forgot to say this, even if we are at a bottom, all of these lines you see, these lines that are going across, are Fibonacci retracement levels from this high to this low, from this high to this low. Actually, I think I have to move this one here. So let's move this one here. So now they both line up. So from both of the important recent highs, we have all of these levels that are going to act as resistance, along with the smaller lines are all moving averages. The 9, the 34, the 50, the 100, the 200. On top of that, all of these anchored VWAP levels, all the thick lines you see, all of these levels are going to act as resistance. Then you have the gap fill areas. Now, I believe if we do bounce from here, we've got to at least fill these gaps. But once we fill these gaps, all of these resistance levels loom, and we've got to take them all out. And then there's this important area where once was support now acts as resistance level at 420, which is going to be a major hurdle to take out. The evidence that SPY could bounce here, if I remove all this, do you see how SPY is moving to a lower low still? I know it was slightly up on Friday. Let's forgive Telechart for not adjusting for dividends. But look at the J and K. In a quantitative tightening environment, this is the most important chart that I look at. The entire downtrend since the highs in 2021, J and K has moved with SPY. This is the first time the SPY has moved to a new low that J and K did not. Also, look at the retail sector. XRT is not hitting a new low while SPY is. Look at XBI on Friday. Look at IBB. Back in the day, this used to be one of the most speculative areas of the market. We're not seeing it hit a new low. On top of that, I can't show you the ratio charts on Telechart, but I look at them on stockcharts.com underneath the SPY. And for the first time during this entire downtrend from 2021, the very first time, my ratio charts are not hitting new lows. QQQ versus SPY, XLY versus XLP, IWF versus IWD, small cap growth versus small cap value, mid cap growth versus mid cap value, big cap growth versus mid cap value. Now, all of these ratio charts are showing positive relative divergence, relative strength, and positive divergence. So I definitely believe we could be in for a big bear market bounce, stronger than this one here, if we have not bottomed, that could see us move into all of these resistance levels, with the big resistance level being 420. So keep that in mind. I think we can wrap it up there. I'm going to let everybody know how we operate at bigwavetrading.com. If you're ever interested in becoming a member, we have a 2-week free trial. Also, the fee is nominal. To me, based on what I see out there, the site is at minimum annually for everything worth $4,000. I only charge $600 a year because I'm a man of the people. I don't want to break the bank, especially not in this market environment. So I basically always run a sale. I say that because I want to let everybody know, once again, warned about this. Multiple free public YouTube video lessons in 2021, warning about the negative divergences. My end-of-day swing trading account went from being 100% invested in February 2021, and all throughout 2021, the amount of capital I was able to get invested on good setups and solid setups dwindled throughout the year. And by the end of 2021, we were finding it basically impossible to find good signals, or great signals were just not there at all. And then the signals that were there, the hit and miss ratio was really starting to increase on the miss side. And then we had the market turn out like it's turned out. So on the end of day account side, we were already minimized. And then by 2022, we were basically 85 to 90% cash. And currently right now, I'm 100% cash in my end of day account. That being said, I do have one new swing position for Monday for members. It's a pretty good signal. I'm going to risk 1% of my account capital in this trade. And by doing that, from where I want to get in to where I'm willing to risk, I'll be moving 15% of my capital into this position just to risk 1R. Now, let's say that I got 5 signals like that. Well, in one day, if they all trigger, I go from being 100% cash to 75% long in 5 stocks. Let's say that this was such a strong signal that I'm willing to risk 2R. Well, overnight, I just went from 100% cash to 30% invested in the market. That's how quickly we can get back to fully invested on the end of day side. I just need some good signals. On the quarterly side, we were warning the major gains that we were seeing from 2018 to the 2021 highs in these quarterly portfolios. They started to diminish. They started to track the S&P 500. The bifurcation between value and growth stocks led to me going 50% cash in these quarterly portfolios last year. And then by February of 2022, we went 100% cash. We're still 100% cash, keeping everyone safe in this environment. So long term, you know what I'm doing. Quarterly, you know what I'm doing. Quarterly portfolios will get back to active when the Fed pivots. Long-term accounts will go all in once I have signs of an actual capitulatory bottom in the market or a Fed pivot. And the day signals are dependent on signals. Just waiting for some great signals. And like always, when I get them, I let everybody know. Right now, I'm granular, guys. I'm a day trader. I'm day trading this market, but I'm implementing break-even stops on my end in the educational account. And then in my two biggest day trading accounts, not active because I need to see some major gains in both my TOS and Webull account. And I'll let everybody know in the TOS account, my profit factor currently sits at 23. Anything over 3 is considered outstanding. I've taken a total of 119 trades in that account. 110 have been for W's, 9 have been for losers. That's a 92% win-loss ratio. And if you go to the public Discord page, you will see my profit and loss graph, and you will see very little drawdowns. Only one stock ever really caused a drawdown. It took 4 trades to fix it using the break-even stops. But you will see it's just grinding higher. The break-even stops are hurting me recently as small caps run, and then I also did go on vacation for 2 weeks, of course, during a time when small caps got hot. But right now I'm granular and long-term. There is no middle. All right, everyone, going to wrap the video lesson up there. Once again, happy Father's Day. Happy Juneteenth. Please, guys, if you liked the video or learned anything during this video, please give me a thumbs up and more. And I'm begging for comments, some interaction. I love discussing and talking shop. Go ahead and leave a feedback. Let me know what you think. Let me know what you want me to talk about. If you have any questions about the data or this chart, please let me know. Aloha.